glamorized the wrong parts of entrepreneurship. We congratulate people on their $10 million fundraise. What did you do? You basically, we don't glamorize people when they take out a loan, right, to buy a house, right? How is that glamorous? You want a thing to have a house, so you got a mortgage, right? You want to build a company, you need some capital, right? That's not glamorized. We should be glamorizing the successful outcomes, not the inputs. What's made it even worse is that we've made our heroes the people who founded unicorns. That just means they were really good at raising money, not that they came up with the outcome. That's a valuation based thing, not a revenue thing. I think that there needs to be a term for the $1 billion revenue companies or the $100 million revenue companies. That's the thing.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast, and today we have Scott Shane with us. Scott is the managing partner at Comeback Capital. He was previously a professor and researcher on entrepreneurship. He's also an LP in several startup accelerators. In this episode, we talk about Scott's story and how he started investing, investment thesis at Comeback Capital, his research on is entrepreneurship in the genes, what gets investors excited in a startup pitch, why founders should prioritize earlier exits, and lots more. So without wasting any time, let's dive straight in. Hey Scott, so good to have you on the VC10X podcast. How are you doing?
Great. Thanks for having me here.
Yeah, pleasure hosting you on the podcast. So excited to have you here. And to get started, can we first have your story and how you started investing?
Yeah, so it's actually a pretty good story. I have an academic side, right? I'm a professor as well as running a venture fund. And back in 1998, when I was teaching at the Sloan School at MIT as an assistant professor on the research track, I thought I didn't have good stories. And I thought that I would be more like the clinical professors if I invested in some startups. I got lucky. The first ones that I picked were successful, so I kept doing it. That's the story of how I started.
Yeah, that's super great. And let's talk about Comeback Ventures, your venture firm. So what's your investment thesis here?
Yeah, so Comeback is an interesting fund. We came about because there are some big name coastal VCs, people from partners at places like Bloomberg Beta or SoftBank, that were traveling through the Midwest of the US looking for a way to invest. And so we are a scout fund for big coastal VCs, plus a way for high net worth individuals in the middle of the US to get better deal flow. If you sit in some place like Pittsburgh or Milwaukee, the local deal flow is too low. And so what we do is find a way to trade deals, to aggregate. That's the model.
Right, that's great. And how do you evaluate these startups deals? And because you being a professor in entrepreneurship and having that in-depth knowledge, so how are you applying that now in your VC career and evaluating startups?
Yeah, so for me and the rest of the team, we are pretty self-aware because we've been angels for a long time before we had the fund. Our fund is a lot of our own money. So we're small. And our advantage is that we are okay with very early stage ventures looking for deals in unusual places, right? There are not a lot of people competing in, say, Southeast Michigan looking for pre-seed deals that are $500,000, right? And so we do that. Our evaluation is pretty light. What we want to just see is, what have people accomplished really quickly off the bat? So if you tell me there's a founder and they have started their business 10 months ago and they've gotten 4 pilot customers paying them $2,000 a month for some business to business software, I'm like, that's a very strong signal that that's interesting. And we would do a quick meeting with the founder. They would pitch us. We look at the basics in a data room, and then we write relatively small checks and see what happens. We're big believers that a large volume is what's important, and placing a lot of bets.
Great. So you're basically coming in as a first investor. Is that correct? And investing where there are signs of early traction, right?
Yeah. So, I mean, we are almost always the first institutional check, and we're trying to bring the other first checks. There may occasionally be like one or two angels in the deal, but rarely ever are we doing a deal where there's another VC who did an actually organized previous round.
Yeah, that's super cool. And you have previously also been a writer at entrepreneur.com, and I was reading some of your blogs. They're really insightful. And I saw one blog that was about that founders should be willing to pay for fundraising to these platforms. So I would love to have your perspective on that.
Yeah, so I want to be clear that, like, because people sort of misinterpret some of this. It's not that you should pay to join a platform, it's that fundraising itself, you are paying for something that is good. And so I would say that a founder should not pay somebody else to raise money for them. But the reason that you're going to get worse valuation terms from better VCs is because you're paying for their connections and you're paying for their value. And that's what I think people should do.
Great. So you're saying that if there is a round that's prepared for you on your behalf and they're taking a percentage cut from that, so that's super understandable, or should be, right?
No.
Yep.
So if people are telling you they will get you money, that's a big negative red flag. If you are presented with two VCs, one who has a stellar reputation and knows everybody and has really been successful, and they are offering you worse financial terms than the other VC who's kind of unknown, who's offering you better terms, I would say pay for the better quality reputation by taking the worst terms.
Great. And I've also learned that you are also an LP in some accelerators. So I would love to understand how being an LP in accelerators is different from being an LP in maybe a VC fund, and what are the similarities and dissimilarities here?
Yeah, so I have invested over the years, right? Going back to like 98 when I started, in lots of different models, right? So I've been a LP in accelerators, I've been an LP in venture funds, I've been an individual angel, I've been part of angel groups, I've been a GP in my own fund. Getting to the point of the difference between being an LP and a accelerator and a VC fund, there's two things. The first one is that accelerators are high volume places, right? And so what you're doing is getting a very large number of bets when you're investing in that accelerator, right? And so I think that that's very useful. The second part of it is more important to me now that I'm a GP. If I'm in somebody's Series A fund, they're not going to be providing me deals for my fund. If I'm an LP in somebody's accelerator, that is going to give me the ability to like ask for the favor to meet the companies like earlier than somebody else who's unconnected gets to meet those companies. And that's really valuable because one of the most important things of being on the VC side is how do I get access to deal flow somebody else doesn't have? Because if everybody can go watch YC demos online, that's not an advantage to me, right? Getting the ability to meet startups in an accelerator a month before somebody else, that's an advantage.
For sure, that makes total sense. You're getting earliest access to those high quality deals. And one more aspect I would like to learn from you is how are accelerators structured different from VC firms? Like, is it because VC firms are running on certain terms that, okay, they have a 10-year cycle, they're going to raise a fund, they're going to deploy that over a 10-year period, and then they're going to return that fund when there are exits, right? So how does the accelerator, does that also follow the similar model, or is it structured more like a company and you're putting in money and then they're investing out of that? So is it more structured more like a company, or is it structured more like a VC fund?
So most of the accelerators that I've put money in are structured more like a VC fund, right? So you're going to put in money. Usually that accelerator is like maybe 2 years of cohorts, and they probably run 2 or 3 cohorts a year, right? And so you're buying into those cohorts, much like you're buying into the investment period of the VC fund. Like that first 4 years, what are they deploying there? There are a couple of differences, right? The accelerator isn't likely to be following on, but the VC fund that you put money in is probably reserving some amount of money for follow-ons. The other difference is that the VC fund is probably structured with a different way to pay for the support staff than the accelerator probably is, so that the numbers are a little different. But the biggest difference of everything is the volume, right? Like you're putting in, let's say, money into an accelerator that is going to have 60 companies. I've never put money into a venture fund that probably has that volume, with the sole exception of one fund, Right Side Capital Management, where I an LP, and I think they are super high volume and following the accelerator model.
Right, absolutely. That makes sense. Great. And now let's talk about entrepreneurship. And you're someone who has been in the space, in the academic space, inside entrepreneurship for quite some time now, and been teaching that subject and also done multiple studies there. So there's one study that I came across which talked about how entrepreneurship is in the genes, right? So you did a study on that can entrepreneurial behavior be transferred from maybe parents to their offspring, their children. So would love to learn what were your findings there on that study.
Yeah, absolutely. So I did a series of studies with some colleagues in the UK, where we literally studied twins, and because there's an experiment of nature there, and identified that there's a component to entrepreneurship that's genetic. And then we went and worked with some molecular geneticists and identified versions of genes, particularly some of the dopamine receptor genes associated with things like ADHD, that are associated with entrepreneurship as well. I mean, this is basic scientific work. I also have a second stream, which is somewhat related, where we studied brain function of investors. We put investors in an fMRI machine and looked at what kinds of pitching activity in experiments like triggered the positive responses experimentally in the entrepreneurs. And one example on that is that when entrepreneurs pitch with passion and enthusiasm, it really does trigger greater interest. And there's a, 25%, roughly quarter, greater likelihood the investors will invest because of that.
Yeah, that's very interesting finding. Any other findings like that? That okay, when maybe the metrics are good and that triggers a better response, or the deck is more beautiful, or maybe there are 2x founders, 3x founders, right? What's the reaction on that?
So we've done some other experiments where we find that the ability to provide both better content and better delivery in the pitches really have an effect. And by that I mean people, when they tell a better story, right? It could, and I'm talking about experimentally doing this, right? Randomly assigning exactly the same thing for everything except, right, the story. Better storytelling, but also more concrete numbers both create positive effects. And so pitching is something that most people think about as an art, but people can study it, and there's a science to it too.
I love it. And have you, I know you've written multiple books. So are there any books of yourself that you'd recommend entrepreneurs to read to maybe also get a scientific knack of it, that this is more of a science as well?
Well, so I mean, I would suggest Googling the different books on different topics. Like, I have a bunch of stuff that I studied. What made like the spin-offs? In the early years when I taught at MIT, we studied the startups that came out of tech transfer. What made some of those successful when most of them were not. Some of the stuff I have a big review book that I did a while ago that talked about the genetic side of many aspects of business, including entrepreneurship. I there's a whole bunch of other policy related ones as well. When you write a lot of books, it's like having a lot of children. I think they're all great equally. Leave it to others to decide which of my children is the best.
Yeah, absolutely. And talking about your study on the genetics aspect in entrepreneurship. So, do you have any biases now while you're investing in entrepreneurs? Are you looking for their backstory? That who are your parents? What were they doing? And making like some assumptions based on that.
No, because the truth is that the basic science stuff is so far removed from the practical situation that you can't really do it on the genetic side. I will say this though, that the thing that has informed me the most are like the studies on pitching, because human beings are terrible decision makers, and that includes investors, including myself. And so what I have to do is check myself all the time that when an entrepreneur is giving a bad pitch, not to infer that it's a bad business and that are bad at building the company. Our biggest successes are generally kind of things we found because others wouldn't do them, because basically like it was really hard to figure out what this person was trying to say, and you're like, then you realize that, oh, there's this really good business underlying it. If I could only help this person, then it could really explode.
Yeah, certainly, and that's a case a lot of times wherein the entrepreneurs are great businessmen. They know their stuff, but they are not too good at articulating it and presenting it, right? Because that's an altogether different skill. So having that in mind is important, right?
Yeah, now I will tell you the other part about this is that we have great success with finding the technical founders who have like great achievements, and they have nothing. Like, you ask, can I see your financial model? Well, what's a financial model? You ask them, like, what's the business model? They're like, huh? Right? And then all of this stuff. But then you say, well, when did you start your company? And they tell you, well, I started it 8 months ago. Okay, can you tell me your traction? And they say, I have 30 customers paying me $30,000 a month in recurring revenue. And you just go, oh my gosh, like they don't even know what they have, right? Like there's clearly the customer had a problem and you solved it. Let's get to the bottom of it and let's build all the other stuff.
Exactly, and that's so important, right? Just if even if you know the basic, business is very simple at its core, right? You have to have something of value, something that's solving someone else's problem, and then they are also willing to pay to get that problem solved. It's as simple as that, right? And maybe,
It
yeah,
is
yeah,
it is as simple as that. And I'm always shocked at how few people like want to tell me I solved person X's problem and they paid me a bunch of money, because it's really at the heart of it. Whenever I meet an entrepreneur, that's all I want to know is you telling me that there were 10 people whose problem you solved yesterday and they gave you some money.
exactly. That's all that matters, right? All right. So, since you have so many learnings, can you share one or two learnings or things that you would want founders to implement in their journey, or maybe aspiring founders to know while they start their founding journey, startup journey?
Well, so the first one that I think is the most important is that the reason you start a company is because you found that people have a problem, you've come up with a solution, and you have evidence that that problem got solved. Um, I will tell you that as somebody who teaches this topic, more and more I find people who want to start businesses for all the wrong reasons. Like everybody thinks, oh, I should start a business because I'm going to get rich. It's actually a terrible way to make money. Like on average, you're not making very much money. If you want to do that, go do financial engineering because that's where the big money gets made for relatively little stuff, right? You do this because like there was a problem and you solved it. And the only way to help a bunch of people get it solved is by selling more and more of that. Like that, that is my number one thing to anybody who wants to be an entrepreneur, and my number one thing when I'm picking entrepreneurs to back.
Yeah, that's so important. And I was just thinking about it today itself about how uh, maybe startups are kind of over glamorized, venture backed startups, that everyone who's thinking about starting a business is thinking first about what can I build that will raise millions of dollars of funding, right? And when they're building it, that's the primary intention, that how can I get the funding, right? Get the first funding. And I think that's wrong for the entire ecosystem, not just themselves. A better way would be you should solve a problem, see if people are willing to pay for it, and solve it well. And then once you see that that problem is solved and people are willing to pay for it, then for scaling, then maybe you can raise venture capital, right? Besides, right, another aspect of this is that it's not necessary even that you raise venture capital. You can build a sustainable business without that as well. And I think that's something that doesn't get talked about enough, right?
Absolutely. So there's two, I think, hugely important points in what you just said. The first hugely important point is that um, bootstrapping is better. Like you should not go take money from people and raise money and make that a goal. What you should do is solve a problem and only raise money when literally you cannot grow fast enough on your own and you just need fuel. It's like the only reason to do this is because you can't get enough fuel. That's the venture, because it's it's very inefficient money. It's not good for the founders. The richest kinds of entrepreneurs in the end were the ones who didn't take much money at all. The second thing is that we've glamorized the wrong parts of entrepreneurship. We congratulate people on their $10 million fundraise. What did you do? You basically, like, we don't glamorize people when they take out a loan, right, to buy a house, right? How is that glamorous? You want a thing to have a house, so you got a mortgage, right? Like you want to build a company, you need some capital, right? That's not glamorized. We should be glamorizing the successful outcomes, not the inputs. What's made it even worse is that we've like made our heroes the people who founded unicorns. That just means they were really good at raising money, not that they came up with the outcome. That's a valuation based thing, not a revenue thing. I think that there needs to be like a term for the $1 billion revenue companies or the $100 million revenue companies. That's the thing.
Right, right. I totally agree, and that's so important to be like talked about more. And I identified that there are three things that are actually bad about raising venture capital. I'm just putting it out there. So first is that it's high risk. The other is that it's high stress. That is going to bring a lot of stress. And the third is that it's going to limit your freedom. That once you're in it, it's hard to get out, right? But if you do it on your own money or bootstrap it, then you still have the freedom that if that doesn't work out, you still have the freedom to move around, do something else, right? Iterate. But once you take venture capital, you're on a path, you've committed to it, and it's your job to make it work, right? Somehow.
Yes, the one thing I would add is that it isn't a purely binary thing. So there is the ability, because we do a bit of this where early companies are raising these tiny rounds of money, right? So somebody goes and raises $500,000 for the company, and maybe they are going to raise not multiple rounds after that. They can pretty much get out. I think the key part about the venture thing is the more venture capital you raise, the more of your company you're giving up, the more the outcome has to be large, right? To pay back everybody, pay yourself for your time, pay the investors for their money. So what you're doing is saying, you know what? if I only bootstrapped this or only took $1 million from investors, I can sell for $25 million and I can become rich. My life gets changed forever. You go and take $50 million and suddenly selling for $25 million is a disaster, right? And so it's not a life-changing event. And that, I think, is such a problem, because what you want to do is be able to say, at this moment in time, the price at which I would sell my business is more than I think it's going to be worth in the future. That's when you should sell.
That's great. That's a great point that you made there. Basically, prioritizing early exits, right? Maybe because these days everyone is after $1 billion valuation, then going after IPO, right? But I think this is something that more founders should be after: building something valuable, raising a round, and then finding a seller or a buyer for your product, your company, and then selling it. And that's gonna make you filthy rich, right? It's gonna change your life forever. Yeah.
So this is the part that I think is missed by a lot of people in thinking about this. If you look at the distribution of acquisitions of companies in the 25 to $50 million range, there are a lot of acquisitions all the time. The number of $1 billion plus acquisitions is so rare that it actually gets you into the Wall Street Journal, because they can print articles about it because they don't have to print every page about what happened, right? And the point of that is, like, when you think about the probability, it's like, I can probably build a $50 million company with a little bit of money. And if I own 90% of that, I am in fact filthy rich, right? And the probability that you're a typical entrepreneur could do that is so much higher than I am going to take venture capital, build a multi-billion-dollar exit, and walk away with the same amount of money, is so much lower.
Right. Totally agree to that point. And one more aspect we can discuss, which is just adjacent to this, is about slower exits, as we are seeing, especially right now amid a downturn. So, what's your perspective on that? The exits, impending exits or impending IPOs that are there?
So you should understand, first of all, that I've been doing this investing for a long time. So this is my third downturn, right? The part of this about this is that when you invest early, like I do, you're investing for the market 8 years from now. I have no idea what the market's going to be like in 8 years, but if I look statistically, mostly we don't have downturns. Mostly we have up markets, right? And so probably it'll be good then in the future. So from my perspective, for me, the slowing exit market that you're describing, which is true and it's happening, is really only affecting the deals I personally did in the mid, 2010s, like 2015 startup that I invested in, right? And the truth is, when I was deciding then, I had no idea what 2023 was going to look like.
Yeah, that's certainly true. And coming to my last main question before we move on to the rapid fire round. So this one is about what's something that you want to see more of in the startup industry?
I just want to see more people who tell me really powerful value propositions and like solving big customer problems at high rates.
Yeah, that's incredible. And one more aspect we can touch upon is about what are some high value markets wherein you can build businesses, high ticket businesses. What are some of those markets?
So this is funny because we don't think about it that way, and I never think about that. I generally don't know much about most markets. I will tell you from my perspective, I always believe that selling to businesses is easier because the term, basically, it's always economics. If I save you time, if I save you money, it can be mathematically determined, and like there's going to be an ROI, and that's going to work. Consumers, like, how do I know what a 20-year-old woman in India is interested in? Like, I have no idea. I have no way to judge, right? And so that's the problem on the consumer side. And so I stick to the business stuff, and to me, it's always just the numbers, and the entrepreneur is going to tell you, I got good numbers. And then I'm like, okay, I understand.
Yeah, certainly. That makes sense. So you prefer B2B more than B2C, right?
Absolutely. And I leave it up to the entrepreneurs to tell me why it's good.
Right. Absolutely. All right. Let's do the rapid fire round now. So here I'll ask you 5 quick questions about the fund at Comeback Capital, and you have to give 5 quick answers. Sounds good?
Yep.
All right. So the first one goes, what are the sectors and regions you're investing in?
Okay, so sectors primarily B2B, but we'll do anything that isn't biomedical or hugely capital intensive. If we're going to invest in regions, we are companies in the US everywhere but Silicon Valley, San Francisco, New York City, and Boston, where all the VCs concentrated.
Great. And what's the typical stage of investment?
Pre-seed primarily, but we'll go some into seed.
Great. And what's the typical check size you put in?
We do 250K usually, but our LPs are active at sidecaring. So the typical round we can put together is 500K.
That's great. And where can our listeners follow you?
So you can follow us on Twitter at comeback.vc, and our website. We post a lot of material, and we do a lot of events and things like that.
That's great. I'll make sure to put all those links in the show notes below. Thank you so much for coming on the podcast, Scott. It was a pleasure hosting you. Loved all the insights that you shared from years of your experience in this field, and pleasure hosting you.
Thank you. Thanks for having me.
Thank you.